Hey everyone, welcome back to FT News. I'm Myra, and Alibaba just released one of the most confusing earnings reports of the year. Because on one side, the company is seeing explosive growth in AI and cloud computing. But on the other side, its core profits absolutely collapsed. And honestly, investors do not seem to know whether to celebrate or panic right now. Alibaba revealed that its adjusted EBITDA, basically one of the company's main profitability numbers, plunged by a massive 84% year-over-year during the March quarter. Yeah, 84%. That is a huge drop for one of China's biggest tech giants. The company's U.S. listed shares initially moved higher after the report came out, but then quickly turned negative as investors started reacting to the details. And honestly, once you look deeper into the report, it becomes very obvious why the market feels mixed. Because Alibaba is basically spending money everywhere right now. AI, cloud infrastructure, semiconductors, data centers, delivery expansion, user acquisition, and massive investments into quick commerce services. The company is spending aggressively because it clearly believes the future belongs to AI-powered ecosystems. But the problem is, that future is becoming extremely expensive. According to Alibaba's report, adjusted EBITDA dropped from over 32 billion yuan last year to just around 1 billion yuan this quarter. That is a gigantic fall. At the same time, operating income actually swung into a loss. And free cash flow also turned deeply negative as Alibaba poured money into infrastructure and expansion. But here is where things get interesting. Even while profitability is crashing, some parts of Alibaba's business are growing extremely fast, especially cloud computing and AI. Alibaba's Cloud Intelligence Group reported revenue growth of 38% year-over-year, reaching over 41 billion yuan. And according to the company, AI-related products have now delivered triple-digit growth for 11 consecutive quarters. 11. That is massive. The company says demand for AI cloud services in China is exploding right now. And Alibaba clearly wants to become one of the dominant AI infrastructure players in the country. The company has been heavily pushing its Qwen family of AI models, which it believes can compete seriously in reasoning, coding, multimodal AI, and enterprise tools. Alibaba also launched enterprise-focused AI agents designed to handle tasks like document editing, coding assistance, meeting transcription, and business research. So while many people outside China mostly know Alibaba for online shopping, internally the company is now positioning itself as a major AI company too. And honestly, this might be one of the biggest transformations happening in global tech right now that people are not talking about enough. Because China's biggest tech companies are now entering a full-scale AI arms race. And Alibaba does not want to fall behind. But there is another huge reason profits are falling right now. Quick commerce. If you have not heard that term before, it basically means ultra-fast delivery services where customers can receive products in under an hour. And apparently, this has become a massive battlefield in China. Alibaba is spending huge amounts of money trying to dominate this market. The company's quick commerce revenue jumped by 57% year-over-year, which sounds amazing. But the problem is the spending required to maintain that growth is enormous. Alibaba admitted these investments are heavily hurting profitability in its China e-commerce business. So basically, Alibaba is sacrificing current profits to aggressively chase future dominance. And honestly, investors are divided on whether the strategy is genius or dangerous. Because there are two completely different stories happening at the same time here. Story number 1. Alibaba's AI and cloud business looks incredibly strong. Cloud growth is accelerating. AI demand is booming. Enterprise customers are adopting its services rapidly. And the company clearly believes AI could become its biggest future growth engine. But story number 2. The spending required to build that future is becoming brutal. Sales and marketing expenses surged massively. Infrastructure spending exploded. Cash flow weakened badly. And core profitability collapsed. So now investors are asking one major question. How long can Alibaba keep spending like this before shareholders lose patience? And honestly, that is probably the biggest concern surrounding the company right now. Because AI investment races are incredibly expensive. Even companies like Microsoft, Meta, Google, and Amazon are spending billions and billions trying to dominate AI infrastructure. Alibaba is now joining that same race inside China. And the company is making it clear that it plans to keep investing heavily. Alibaba executives specifically said they will continue investing aggressively into AI plus cloud computing to strengthen long-term competitive advantages. So this is probably not a short-term spending problem. This may be the company's strategy for years. Another interesting detail from the report is that Alibaba integrated AI directly into its shopping ecosystem. The company added e-commerce functionality into the Qwen app and launched AI shopping assistants inside Taobao, which honestly shows how seriously Alibaba wants AI embedded into every part of its business. Shopping, search, cloud, enterprise tools, delivery, everything. And while the company's total revenue still grew 3% year-over-year, some investors were disappointed because it slightly missed expectations. That also added pressure to the stock. Meanwhile, international e-commerce growth was solid, but apparently not strong enough to fully impress the market. Still, there are definitely some positives here. Alibaba's international commerce losses narrowed significantly. Cloud profits improved. Quick commerce order value improved. And AI-related customer growth appears extremely strong. So this is not a collapsing company. This is more like a company aggressively rebuilding itself around AI, even if it hurts financially in the short term. And honestly, this might end up becoming one of the defining business stories of the next few years. Because if Alibaba's AI strategy works, these investments could eventually look very smart. But if the spending continues without enough long-term returns, investors could become much more nervous. Right now, Alibaba basically looks like a company caught between two different eras. The old Alibaba, e-commerce dominance and stable profitability. And the new Alibaba, AI infrastructure, cloud services, enterprise tools, and ultra-fast delivery ecosystems. And the transition between those two worlds is clearly becoming extremely expensive. My final thoughts? Alibaba's report honestly feels like a massive gamble. The company is betting huge amounts of money that AI and cloud demand will eventually outweigh today's profit collapse. And if China's AI market keeps exploding, Alibaba could still become one of the biggest winners of the entire AI boom. But right now, investors are being asked to accept pain today for a possible payoff tomorrow. And not everybody is comfortable with that. This is Myra from FT News, signing off.